It is the gold standard of American agriculture. For years, U.S. beef was a symbol of quality and a cornerstone of a booming trade relationship with the world's biggest market, China, a promise of prosperity for thousands of American ranchers. Then, with the stroke of a pen, it was all but erased. In March 2025, China quietly shut the door on American beef, creating a billion-dollar vacuum. And from the north, a willing rival was ready to fill it overnight. How was a quiet, bureaucratic decision in Beijing weaponized to ignite a global food fight? To understand the shock of the collapse, you have to understand the height of the boom. For a brief, brilliant moment, American beef was on top of the world. After years of being locked out, the Phase 1 trade deal signed in 2020 blasted the doors open. China's burgeoning middle class had an insatiable appetite for high-quality protein, and American grain-fed beef was the pinnacle of status and flavor. For U.S. ranchers and meat packers, this was the promised land. A market of 1.4 billion people willing to pay a premium. American producers invested heavily, retooling facilities and expanding herds, specifically to cater to Chinese tastes and standards. It was seen as the golden age, a multi-billion-dollar success story and one of the few tangible wins from a bruising trade war. But beneath the surface of this lucrative trade, the ground was constantly shifting. The economic partnership was always shadowed by a deep and intensifying geopolitical rivalry. While American ranchers saw customers, Beijing saw vulnerabilities. The COVID-19 pandemic and worsening relations with the West had crystallized a core objective for the Chinese government: food security. The idea of relying on a primary geopolitical rival for a critical food source was becoming strategically untenable. Quietly, China began to build a strategy of diversification, seeking new, more politically aligned partners. Simultaneously, Russia, watching from the sidelines, was developing its own agricultural ambitions, particularly in its Far East, building infrastructure with one specific customer in mind. The booming beef trade wasn't a bond of trust, it was a temporary alignment of interests, waiting for the first political shockwave to break it apart. The weapon, when it was finally deployed on March 27, 2025, was not a missile or a tariff. It was paperwork. In a move of devastating bureaucratic precision, China simply declined to renew the export licenses for hundreds of American beef processing facilities. There was no dramatic announcement, no public ban. It was a quiet, suffocating regulatory squeeze. The numbers reveal the brutal efficiency of this tactic. In the weeks prior, the U.S. was shipping roughly 2,000 tons of beef to China every week. In the last week of March, that number plummeted to just 54 tons, a 97% collapse. The viral headline of 150,000 tons rejected wasn't about a single shipment being dumped in the ocean, but something far more strategic. It represented the estimated annual market share that had just been choked off. The official justification was a smokescreen of compliance and a need for re-registration. But Beijing was playing a much larger game. This wasn't just about America. At the same time, China launched broad investigations into its other major beef suppliers, including Brazil, Argentina, and Uruguay. This created widespread market uncertainty, allowing China to reset the terms of trade with all its partners. The strategy served multiple purposes. Firstly, it was a powerful political tool against Washington, demonstrating that China could inflict targeted economic pain without firing a single shot in the ongoing trade war. Secondly, it advanced China's core goal of diversification. By disrupting the market, Beijing could pivot towards suppliers it deemed more reliable or politically expedient. Thirdly, it was a move to protect its domestic producers. By tightening imports, the government aimed to bolster its own cattle industry, a key part of its long-term food security vision, even if it meant risking short-term price hikes for consumers. This was a calculated move, not a rash decision. It created a paper wall that was far more effective than a tariff. A tariff can be negotiated or absorbed. Being locked out of the system entirely is a commercial death sentence. China had weaponized its regulatory power, turning the keys to its market into a lever of global influence, and it had just turned the lock on the United States. As the door slammed shut on American ranchers, another one swung wide open. The moment China choked off U.S. supply, its customs agency made another announcement. Imports of Russian beef and byproducts were approved, effective immediately. The result was what looked like an overnight heist of a billion-dollar market. Russia, it seemed, had won the trade lottery. But this was no accident. It was the culmination of a decade of strategic alignment and patient investment. While America focused on quarterly profits, Russia and China were playing the long game. Their bilateral trade had already surged to nearly $240 billion by 2024, built on a foundation of political alignment against the West. Agriculture was the next frontier. Research shows that as early as 2020, Russia was systematically ramping up food exports to China, focusing on fish, oilseeds, and meat. A key part of this strategy was the development of Russia's Far East, particularly regions like Primorsky Krai. Moscow poured resources into building up agricultural infrastructure right on China's doorstep, creating a dedicated supply chain designed for one purpose: to feed its giant southern neighbor. When the opportunity arose, Russia was perfectly positioned to exploit it. It had the political will, the geographical proximity, and the products ready to go. The term overnight doesn't refer to Russia building an entire industry in 24 hours. It refers to the speed at which the political decision in Beijing unlocked a market that Russia had spent years preparing for. For China, the benefits were obvious. They were swapping a contentious, unreliable supplier for a politically friendly neighbor who was eager to please and less likely to challenge them on other geopolitical issues. This move cemented the growing no limits partnership, extending it from energy and military cooperation deep into the food supply chain. It sent a chilling message to Washington. In the new world of strategic competition, your economic rivals are coordinating against you. Russia didn't just stumble into a market opening. It was handed the keys by a partner who wanted to see America lose. The $1.2 billion prize wasn't just a commercial victory for Russia, it was a shared geopolitical victory with China. This leaves the American beef industry in a strategic bind, adrift in a market it once dominated. The path back is unclear and fraught with obstacles. The first option is to fight through the bureaucracy, a painstaking process of re-registering facilities one by one, with no guarantee of success and subject to the political whims of Beijing. It's a slow, humbling process that puts all the power in China's hands. The second option is high-level diplomacy, but Washington now comes to the negotiating table severely weakened, having been outmaneuvered. The third and most realistic path is diversification. The industry must now aggressively pivot to other potential markets, pushing harder in Japan, South Korea, and the burgeoning economies of Southeast Asia. But these are not empty markets. They are mature, competitive, and fiercely contested. None of them can single-handedly absorb the massive volume that was once destined for China. The American beef industry is facing a painful new reality. It was checkmated not by an open declaration of war, but by a stealthy administrative maneuver that its primary geopolitical rival was perfectly positioned to exploit. They are now on the outside looking in, forced to rebuild their global strategy from a position of weakness. The fallout from this paper war is felt most acutely in the American heartland. For a multi-generational ranching family in Nebraska, the promise of the Chinese market wasn't just an abstract economic opportunity, it was a lifeline. It meant investing millions in genetics, feed programs, and equipment to meet the specific demands of Chinese consumers. It was a bet on the future, a promise of stability for their children. When the market evaporated overnight, that future became terrifyingly uncertain. The plunge from 2,000 tons a week to just 54 isn't just a statistic, it's a direct hit to their bottom line. The ripple effect is immediate. The price of cattle at local auctions begins to fall as the backlog of beef builds up. The meatpacking plants, which hired extra staff to handle the Chinese contracts, are now facing the prospect of cutting shifts. The local feed supplier, the veterinarian, the equipment dealer, an entire ecosystem built on the foundation of this trade is now trembling. This isn't a problem for Wall Street, it's a crisis for Main Street. The ranchers did everything right. They produced a world-class product that their customers wanted, but they were pawns in a much larger geopolitical game. And now they are paying the price for a diplomatic failure that happened half a world away. Their livelihood was traded away not in a negotiation, but in a quiet bureaucratic ambush. Conversely, across the border in Russia's Primorsky Krai, the mood is one of triumphant opportunity. For a Russian agricultural conglomerate that invested heavily in its beef operations, the long-shot bet on China has paid off spectacularly. This isn't just about profit, it's about national pride and strategic success. The influx of Chinese capital and demand means new jobs, further investment, and a sense of ascendancy. They are not just selling a product, they are cementing a powerful alliance. Meanwhile, in Shanghai, the story is more complex. For a middle-class Chinese family, the sudden disappearance of American beef from supermarket shelves creates a new set of calculations. Beijing's strategy is a high-stakes gamble. By prioritizing domestic producers and politically friendly suppliers like Russia, the government risks disrupting the supply of a highly sought-after consumer good. Will the new Russian beef match the quality and consistency that consumers had grown accustomed to from American brands? Will the shift lead to higher prices or shortages? This is the domestic trade-off at the heart of China's decision. Beijing is betting that it can manage consumer expectations and that the long-term strategic gain of reducing reliance on the U.S. is worth the risk of short-term market instability. For the Chinese consumer, the geopolitical chess match has landed directly on their dinner plate. The global food chain has been irrevocably altered. A handshake deal can no longer be trusted when a regulatory decree can erase a billion-dollar market overnight. Food is no longer just sustenance. It is a primary currency of power in the 21st century geopolitical contest. The United States has received a painful lesson in the vulnerability of its agricultural might, while Russia and China have demonstrated the potent synergy of their strategic partnership. The farm has officially become a battlefield, and the entire world is watching to see who reaps the harvest. In this new global arena, is the future of food won with trusted handshakes or strategic chess moves? Are you a producer or a consumer caught in this trade war? Share your story and perspective in the comments below.